Hi, this is a second complete comprehensive example. In this sum, we will deal with the situation where goodwill is brought in by the incoming partner and is withdrawn by the sacrificing partners. So let's go to the example sum. Example sum. W and R are partners in a firm sharing profits in the ratio of 3:2. The balance sheet as at 31st March 2019 was as follows. We have the balance sheet that is given to the left of the screen. Additional information is given to the right of the screen. It says, on the above date, C was admitted for 1/6 share in the profits of the firm on the following terms. First point, C will bring in rupees 30,000 as his capital and rupees 10,000 for his share of goodwill premium, half of which will be withdrawn by W and R. Second point, debtors of rupees 1,500 will be written off as bad debts and a provision of 5% will be created for bad and doubtful debts. Third point, outstanding salary will be paid off. The fourth point, stock will be depreciated by 10%, furniture by rupees 500 and plant and machinery by 8%. Fifth point, investments of rupees 2,500 not recorded in the books was to be taken into account. The sixth point, a creditor of rupees 2,100 not recorded in the books was to be taken into account. Prepare the revaluation account, the partner's capital accounts and the balance sheet of the new firm. So here if we see the first point, the premium for goodwill which is brought in by the incoming partner C is rupees 10,000, half of which was withdrawn by W and R. So the sacrificing partners W and R withdraw half of the premium for goodwill. So part premium for goodwill withdrawn. Let's go ahead with the solution. We'll begin by preparing the revaluation account, followed by the partner's capital accounts and then the balance sheet. Solution. Revaluation account. Left side debit side and right side is the credit side. Particulars, rupees, particulars, rupees. The first additional information about the incoming partner C bringing in capital and premium for goodwill will not affect our revaluation account. Let's go to the second point. Debtors of rupees 1,500 will be written off as bad debts and a provision of 5% will be created for bad and doubtful debts. So let's see the journal entries for this. We'll prepare the working notes and see the journal entries. The first journal entry is for writing off the bad debts of 1,500 rupees. Bad debts account debit. To sundry debtors. ₹1,500 written off as bad debts for bad debts written off. The second journal entry is to provide for the bad debts. Now if we see our liability side of the balance sheet, there's a provision for bad debts figure which is given as 2,000 rupees. So we can utilize that for the bad debts. So the next journal entry, provision for bad debts account debit 1500 to bad debts account 1500 for providing for bad debts. Third journal entry. Now let's calculate the amount of new provision for bad and doubtful debts. So we had the original amount of debtors 18,000. We subtracted the bad debts of 1,500, which is equal to rupees 16,500, and on that we need to make a 5% provision that comes up to rupees 825 rupees. Now after utilizing 1,500 for the bad debts to be written off, we are left with a provision of 500 rupees. But we require provision of 825 rupees. So there's an excess of 325 rupees which we need to debit to the revaluation account. So revaluation account debit 325 to provision for bad debts 325 for creating further provision. So let's insert that in the revaluation account to provision for doubtful debts account 325. The third point is outstanding salary will be paid off. It's just a liability which is going to be paid off with the journal entry outstanding salary to cash account. So it will not affect the revaluation account. The fourth point, we have that the stock will be depreciated by 10%. So to stock account 2,000 rupees. Furniture is to be depreciated by 500 rupees. So to furniture account 500 rupees. And plant and machinery is to be depreciated by 8%. So that comes up to 8% of 40,000, 3,200 rupees. The fifth point says investments of rupees 2,500 not recorded in the books of accounts was to be taken into account. We are bringing an unrecorded asset into existence, so it's by investment account 2,500 rupees. And final point, a creditor of rupees 2,100 not recorded in the books was to be taken into account. So we are creating an unrecorded liability to creditors account rupees 2,100. All the items are completed. Let's check whether we are left with a loss or a gain. The total of the debit side is 8,125. Whereas the total of the credit side is 2,500 rupees. So the greater total 8,125. We are left with a loss, and the amount of loss is 5,625. 25 rupees. So by loss on revaluation transferred to partners capital accounts. We have W and we have R. The total loss 5,625. So on dividing by old profit sharing ratio of 3:2, we get for W it's 3375 and for R it's 2250. So this is a revaluation account which is prepared by us. We are left with the loss and we've divided the loss among the old partners W and R in their old profit sharing ratio, which is 3:2. Next, let's prepare the partners capital accounts. Partners capital accounts. Left side is the debit side, right side credit side. Particulars. Partner W, partner R and partner C. Particulars. Partner W, partner R and partner C. Let's bring down the balance of the capital accounts by balance brought down 60,000 against W, 40,000 rupees against R. We'll insert the capital which is brought in by the incoming partner C by cash account. We are using cash account because on the asset side it says cash account here and not the bank account. C is bringing in rupees 30,000 as his share of capital. Next, we will transfer the loss on revaluation to revaluation account. The revaluation loss was 3375 for W and 2250 for R. We've entered the loss on revaluation. Let's deal with the reserves. There's a general reserve of rupees 5,000. Needs to be distributed among all partners in OPSR. So by general reserve account, rupees 5,000 in 3:2, 3,000 against W and 2,000 rupees against R. There are no fictitious assets. Let's treat the premium for goodwill brought in. There's no mention of the sacrificing ratio or the new ratio. So the sacrificing ratio is equal to the old ratio, which is equal to 3:2. So write the entry for the distribution of premium for goodwill. Account 10,000 rupees divided in sacrificing ratio 3:2, 6,000 against W and 4,000 against R. The premium for goodwill has been withdrawn by the partners, half of which has been withdrawn. So to bank account for withdrawing the PFG, it's 3,000 rupees W has withdrawn and 2,000 rupees R has withdrawn. we have completed the capital accounts. We'll balance it. The total of W, credit side greater 69,000. We have two balance carried down. For W, we need to take 69,000 and subtract 6,375 and we get 62,625. Let's do the same thing for R. Greater total 46,000 minus 4,250 rupees, which is 41,750 rupees. The balance carried down for the new partner C is 30,000 rupees. So this is a capital accounts which is prepared by us. Next, let's go ahead and prepare the balance sheet. Balance sheet as at 1st April 2019. Liabilities rupees and assets rupees. Let's begin with the sundry creditors. The original balance 20,000 rupees. We need to add from the sixth point, we need to add 2,100 rupees. So now it's 22,100 rupees. We'll deal with the provision for bad debts on the asset side of the balance sheet. Outstanding salaries is paid off, so that will not appear. General reserve has been distributed, so that also will not appear. We'll insert the capital accounts of the partners. We have W, R and C. We'll check out the capital balances. It's 62,625, 41,750, and for the new partner C, it's 30,000 rupees. So the total of the capitals comes to 1,34,375 rupees. We'll go ahead with the asset side. Cash. The opening balance of cash was 12,000 rupees. Capital brought in by partner C, incoming partner, was 30,000. The pre-FG bought in by him was 10,000. But the sacrificing partners withdrew half of the PFG, so I'll subtract the 5,000 rupees. And also we are paying off outstanding salary, amount is 3,000 rupees. So the final figure for cash ₹44,000. Next, debtors. The original figure of debtors 18,000 rupees less bad debts, which amounted to 1,500 rupees. We are left with a balance of 16,500, and our new provision for bad debts was 5% of 16,500 rupees, which was 825. So the final figure of debtors was 15,675 rupees. Stock, the original figure is 20,000, but we reduced the stock by 10%, so it's now 18,000. Furniture, original figure 40,000, we reduced by 500 rupees, so now it's 39,500. Plant and machinery, original figure 40,000, we reduced by 3,200 rupees, so it's 36,800 rupees. We need to bring the investments into account. The amount of the investments is 2,500 rupees. We'll remove the split and see if the balance sheet is tallying. Both sides tally with 1,56,475 rupees. So let's look at this was the revaluation account prepared by us. There was a loss on revaluation, which we transferred to the partners' capital accounts. This is the partners' capital accounts. The balance of partners for W, 62,625 rupees, R, 41,750 rupees, and C, 30,000 rupees. This is the balance sheet, both sides tallying with 1,56,475 rupees. And below the balance sheet was the working notes done by us for the bad debts and the provision for bad and doubtful debts. The first entry was for writing off the bad debts. The second entry was for utilizing the existing provision to the extent of 1,500. And then we needed a provision of 825. We had only 500 balance in the provision for bad debts account. So we debited the revaluation account for the excess required, which is 325 rupees. 825 rupees minus the 500 rupees. So we debited the revaluation account with 325 rupees.